The $32 billion fraud, how Sam Bankman-Fried fooled everyone and destroyed the crypto industry. On November 11, 2022, a 30-year-old billionaire wearing cargo shorts and a wrinkled t-shirt sat in his $40 million penthouse in the Bahamas, frantically typing messages to his lawyers as his entire empire collapsed around him. Just 5 days earlier, Sam Bankman-Fried, known universally as SBF, had been worth $26 billion, was featured on the cover of Forbes and Fortune, had dinner meetings with Bill Clinton and Tony Blair, testified before Congress about cryptocurrency regulation, and was considered the most trustworthy person in an industry known for scams. Now, his company FTX, once valued at $32 billion and considered the safest cryptocurrency exchange in the world, was bankrupt, and $8 billion of customer money had simply vanished. But here's what makes this story absolutely insane. SBF wasn't some mysterious anonymous hacker or a shadowy criminal mastermind. He was the golden boy of crypto, the guy who said all the right things about regulation and consumer protection, the effective altruist who claimed he was only getting rich so he could give it all away to charity. And behind the scenes, he was running one of the most brazen frauds in financial history, using customer deposits as his personal piggy bank to fund a hedge fund, buy real estate, make political donations, and bail out failing crypto companies. This isn't just a story about cryptocurrency. This is a story about how a math prodigy from MIT convinced the smartest people in the world, from Sequoia Capital to BlackRock to the Ontario Teachers' Pension Plan, that he was the future of finance, and how it all came crashing down in less than a week when a single tweet exposed the entire house of cards. So let me take you back to 2017, when a young trader at Jane Street Capital had an idea that would eventually lead to the largest fraud prosecution since Bernie Madoff. Sam Bankman-Fried wasn't a typical crypto bro. He didn't drop out of college to chase a dream. He didn't come from poverty with something to prove. He was actually the son of 2 Stanford law professors, graduated from MIT with a physics degree, and went to work at Jane Street Capital, one of the most prestigious quantitative trading firms on Wall Street. He was brilliant, socially awkward, and obsessed with effective altruism, a philosophical movement that argues you should maximize your positive impact on the world, often by earning as much money as possible and donating it strategically. In 2017, SBF discovered something interesting. Bitcoin was trading at different prices on different exchanges, sometimes as much as 30% higher in Japan than in the US, and this created an arbitrage opportunity. He quit Jane Street, founded a trading firm called Alameda Research with some friends from the effective altruism community, and started exploiting these price differences, buying Bitcoin cheap in one country and selling it expensive in another. The profits were enormous, sometimes millions of dollars per day, and within a year SBF had made enough money that he could have retired wealthy, but that wasn't the plan. He wanted to build something bigger. The problem with arbitrage is that it disappears once everyone knows about it. As more traders entered the space, the price differences narrowed and Alameda's profits shrank. SBF needed a new edge, and he realized something crucial. The cryptocurrency exchanges themselves were terrible. They crashed during high volume, had terrible user interfaces, charged high fees, and most importantly, they weren't regulated or trustworthy. Millions of dollars had been lost to exchange hacks and scams. So in 2019, SBF founded FTX, a cryptocurrency derivatives exchange that would be different. It would be professional, reliable, and most importantly, it would attract institutional investors who were scared to use existing crypto exchanges. The pitch was perfect for the moment. Crypto was growing, institutions wanted exposure but didn't trust existing exchanges, and here was this MIT graduate, this Wall Street trader, who understood both traditional finance and cryptocurrency, who spoke the language of regulators and compliance, who seemed like the adult in a room full of children. And FTX's growth was explosive, absolutely explosive. Within a year it was processing billions in daily trading volume. Within 2 years it had raised money from the biggest venture capital firms in the world at a $32 billion valuation, and SBF became a billionaire many times over on paper. But here's where the story gets interesting, because while FTX was growing into a legitimate business, Alameda Research, SBF's original trading firm, was still operating. And here's the critical detail that you need to understand, because this is where the entire fraud originates. Alameda had special privileges on FTX that no other customer had. Alameda could trade with essentially unlimited leverage, could borrow against positions in ways that other customers couldn't. And most importantly, Alameda had a secret backdoor that allowed it to have a negative balance, to owe FTX billions of dollars without triggering the normal liquidation mechanisms that would apply to any other customer. Why did this exist? SBF claimed it was necessary for Alameda's market-making activities, that Alameda needed special privileges to provide liquidity to the FTX platform. But what it actually meant was that Alameda could lose enormous amounts of money on bad trades, and instead of being liquidated like a normal customer, those losses would simply accumulate as a debt that Alameda owed to FTX. And where did FTX get the money to cover Alameda's losses? From customer deposits. Now, before we go further, you need to understand the fundamental rule of cryptocurrency exchanges, the rule that separates legitimate businesses from frauds. Customer deposits must be kept separate from company funds. When you deposit money on an exchange, that money is supposed to stay in a segregated account. You can trade with it, you can withdraw it, but the exchange cannot use it for its own purposes. This is basic. This is foundational. This is the bare minimum requirement for operating a legitimate financial business. And SBF knew this. He absolutely knew this because he spent 2021 and 2022 testifying before Congress, giving interviews to financial media, writing op-eds about the importance of regulation and consumer protection in cryptocurrency. He positioned himself as the responsible adult who understood that crypto needed rules, who wanted to work with regulators to build a safe, trustworthy industry. He literally testified before Congress about the importance of keeping customer funds separate, and the entire time, he was violating this rule on a massive scale, using billions of dollars in customer deposits to fund Alameda's trading activities, to bail out failing crypto companies, to make political donations, to buy real estate to fund his lifestyle. And the lifestyle was something else. SBF cultivated this image of a disheveled genius who didn't care about money. He wore cargo shorts and t-shirts to meetings with billionaires. He drove a beat-up Toyota Corolla. He slept on a beanbag in his office. He claimed to live on a few dollars a day and was only accumulating wealth so he could give it away. But behind the scenes, he and his 9 roommates, all FTX and Alameda executives, were living in a $40 million penthouse in Albany, a luxury resort in the Bahamas. They were throwing parties, dating each other in this weird, incestuous startup culture. And most bizarrely, they were all taking stimulant medications prescribed by a psychiatrist who lived with them in the penthouse. This wasn't a normal company. This was a frat house crossed with a hedge fund crossed with a polycule, where the CEO was dating the co-CEO of Alameda Research, Caroline Ellison, where everyone lived and worked together in this pressure cooker environment, where decisions involving billions of dollars were being made by people in their 20s who were sleep-deprived, stimulant-addled, and completely disconnected from the reality of what they were doing. Caroline Ellison is a crucial character in this story. She was the co-CEO of Alameda Research. She was SBF's on-and-off girlfriend. She was a Stanford math graduate who had also worked at Jane Street, and she would eventually be the key witness who brought SBF down. But in 2021 and 2022, she was running Alameda while it hemorrhaged money on increasingly risky trades. And here's what's absolutely wild. Alameda wasn't even particularly good at trading. They lost money constantly. They made huge bets that went wrong. They were paying above market rates to borrow assets. And every time they lost money, they simply borrowed more from FTX to cover the losses. And those FTX funds came directly from customer deposits. By mid-2022, Alameda owed FTX over $8 billion, and FTX didn't have $8 billion in company funds. They had customer deposits, which meant that if a significant number of customers tried to withdraw their money at once, FTX would be unable to pay them. But SBF had a plan to fix this, or at least he thought he did. He started raising more money for FTX at higher and higher valuations. He got investments from Sequoia Capital, Tiger Global, BlackRock, the Ontario Teachers' Pension Plan. These weren't crypto-native investors gambling with play money. These were sophisticated institutional investors who did extensive due diligence, who had teams of analysts, who were investing hundreds of millions of dollars. And somehow they all missed that FTX was using customer deposits to fund Alameda's trading activities. How did they miss it? Because SBF was incredibly good at explaining things in a way that made concerns seem naive. He had this way of making you feel stupid for asking basic questions. He would dive into complex mathematical models and trading strategies until your eyes glazed over, and then he'd pivot to talking about effective altruism and how he was going to give away all his money to save the world, and somehow you'd leave the meeting thinking you just met a genius instead of a fraudster. And SBF wasn't just raising money, he was spending it on reputation and influence. He bought naming rights to the Miami Heat Arena, turning it into FTX Arena. He ran Super Bowl commercials featuring Larry David. He sponsored Formula One teams. He gave hundreds of millions to effective altruism causes. And most importantly, he became one of the largest political donors in America, giving over $40 million in the 2022 election cycle. Mostly to Democrats but also to Republicans, and he claimed this was all about promoting effective altruism and good governance. but in retrospect it looks a lot like buying protection and influence. He had meetings with Gary Gensler, the SEC chairman. He testified before Congress multiple times. He was treated as an expert whose opinion mattered on cryptocurrency regulation, and the entire time he was running a massive fraud. The cracks started showing in 2022. The crypto market crashed after Terra Luna's collapse in May, and suddenly a lot of crypto companies that had been over-leveraged and reckless found themselves in trouble. Voyager, a crypto lending platform, filed for bankruptcy. Celsius Network froze withdrawals. Three Arrows Capital, a major crypto hedge fund, imploded, and the contagion was spreading through the industry. And here's where SBF made a decision that would eventually destroy him. He started using FTX customer funds to bail out failing companies. He positioned this as responsible leadership. As FTX being the savior of the crypto industry, he did media appearances talking about how FTX was strong enough to help struggling companies. He compared himself to J.P. Morgan during the 1907 financial panic, stepping in to save the system. But he wasn't using FTX's money to do this. He was using customer deposits, billions of dollars that didn't belong to him, and he was using them to prop up companies that were already dead, throwing good money after bad, and every dollar he spent making himself look like a hero was a dollar that customers wouldn't be able to withdraw when they needed it. By November 2022, Alameda Research owed FTX approximately $8 billion, and this debt was backed by collateral that was mostly FTX's own exchange token. Think about how insane this is. Alameda had borrowed $8 billion from FTX, and the collateral for that loan was a token that FTX itself had created. It's like borrowing money from a bank and using the bank's own stock as collateral if the stock price falls. The collateral becomes worthless, and you still owe the money, except in this case, the stock price was entirely dependent on confidence in FTX. So if people lost confidence in FTX, the FTT token would crash, the collateral would evaporate, and Alameda's debt would be backed by nothing, which would mean FTX was insolvent, which would cause people to lose more confidence, which would make FTT fall further. It was a death spiral built into the system from the beginning. And then, on November 2, 2022, everything started to unravel because of one document. CoinDesk, a crypto news outlet, published a leaked balance sheet from Alameda Research, and buried in the numbers was a shocking revelation. Alameda's largest asset, representing a huge portion of its balance sheet, was FTT tokens, billions of dollars worth of FTT, and this immediately raised questions because why would a trading firm have so much of its balance sheet in one token, and not just any token, but the token created by its sister company FTX? The implications were obvious to anyone paying attention. Alameda was propping up FTX, or FTX was propping up Alameda, or they were propping each other up in some kind of circular scheme, and if FTT's price fell, both companies could be in serious trouble. The crypto community started asking questions on Twitter, demanding clarity about the relationship between FTX and Alameda, and Caroline Ullason, in what might be the worst crisis management decision in business history, responded with a tweet that made everything worse. She said that the balance sheet that leaked was incomplete, that Alameda had over $10 billion in assets that weren't included, and that Alameda would be happy to buy all of someone's FTT at $22 if they wanted to minimize their risk. This tweet was supposed to be reassuring, but it had the opposite effect because if Alameda was so strong, why were they offering to buy FTT at a specific price? Why did they seem desperate to prevent FTT from being sold? What were they afraid of? And then Changpeng Zhao, known as CZ, the founder of Binance, FTX's biggest competitor, decided to light the match that would burn everything down. On November 6, CZ tweeted that Binance would be liquidating their entire position in FTT, which was worth about $580 million. He claimed this was just risk management following the Alameda revelations, but everyone understood this was a declaration of war. CZ was one of the most powerful people in crypto. If he was dumping FTT, other people would follow, and that's exactly what happened. The price of FTT started falling, slowly at first, then accelerating as more people sold, and this created exactly the death spiral that the system was vulnerable to. As FTT fell, Alameda's collateral for its $8 billion debt to FTX became less valuable, which made people more worried about FTX's solvency, which made more people want to withdraw their funds from FTX, which put more pressure on FTX's finances, which made FTT fall further. Within 24 hours, customers had requested over $5 billion in withdrawals from FTX, and FTX only had about $1 billion in liquid assets because the other $8 billion was stuck in Alameda, locked up in bad trades and illiquid positions. SBF tried everything to stop the collapse. He reached out to investors begging for emergency funding. He called CZ trying to negotiate. He posted reassuring messages on Twitter claiming that FTX was fine and assets were secure. But nobody believed him anymore. The numbers didn't work. If FTX was fine, why couldn't they process withdrawals? Why was there a backlog? Why were people waiting days to get their money? And then, in a moment of desperation that shocked everyone, SBF announced that FTX had reached an agreement for Binance to acquire the company. His biggest competitor, the person who had just attacked him, was going to buy FTX and presumably make customers whole. For about 12 hours, people thought maybe this would work. Maybe CZ would be the white knight who saved the day. But then Binance did their due diligence, actually looked at FTX's books, and discovered that the hole was much bigger than anyone had publicly acknowledged. $8 billion in customer funds were missing, not temporarily locked up, not in illiquid positions that could be sold given time, but gone, stolen, used for purposes that had nothing to do with customer trading. November 9th, Binance walked away from the deal, releasing a statement saying that the issues at FTX were beyond their control and beyond their ability to help. And that was it, that was the end. FTX was dead. There would be no bailout, no white knight, no miracle save. On November 11th, SBF resigned as CEO and FTX filed for bankruptcy. And in the bankruptcy filings, the new CEO, John Ray III, a restructuring expert who had overseen the unrun bankruptcy, wrote something extraordinary. He said that in his entire career, spanning multiple decades and some of the largest corporate failures in American history, he had never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. The company had no accounting department. Expenses were approved via emoji in Signal chats. Money was tracked in a QuickBooks account that multiple people had access to. Employees could take unlimited amounts of money just by asking. There were no board meetings, no oversight, no controls whatsoever. It was financial chaos masquerading as a sophisticated business. And where was all the money? Some of it had been lost in Alameda's bad trades. Alameda had made enormous bets on various cryptocurrencies that crashed in value. They had lent money to other crypto companies at favorable rates as part of SBF's bailout spree, money that would never be recovered, but hundreds of millions had also been spent on things that had nothing to do with business. $300 million on real estate in the Bahamas, $40 million for the penthouse where SBF and his executives lived, $93 million on a personal loan to SBF, $55 million to an executive's family business, $2.5 million on catering for events, and those political donations, over $40 million in the 2022 cycle alone. All of it came from customer funds. Every dollar that SBF gave to politicians, every dollar he spent on Super Bowl commercials and arena naming rights, every dollar he donated to effective altruism causes to burnish his reputation as a thoughtful philanthropist, all of it was stolen from customers who had trusted FTX with their savings. The human cost of FTX's collapse is staggering and ongoing. Over 1 million creditors lost money. Some people had their entire life savings on FTX, retirement funds, college savings, business operating capital, money they needed to survive, and it was just gone. The bankruptcy process would take years. And even in the best-case scenario, people would recover pennies on the dollar, and the psychological impact goes beyond the money. People felt betrayed. They had believed in SBF. They had trusted him because he said all the right things about regulation and consumer protection, because he seemed different from other crypto founders, more responsible, more adult, and it had all been a lie. He had been robbing them while lecturing Congress about the importance of protecting consumers. In SBF's response to all of this, he went on an apology tour, doing interviews with mainstream media, tweeting constantly, appearing on podcasts, and his message was absolutely delusional. He claimed he hadn't known about the commingling of funds between FTX and Alameda, that he had been misled by his executives, that he had made mistakes but hadn't committed fraud, that he was as shocked as anyone to discover the $8 billion hole. None of this made any sense. He was the CEO, he had founded both companies. He was dating the co-CEO of Alameda, they all lived together in the same penthouse. But he wanted everyone to believe he had no idea that $8 billion of customer money had been lent to Alameda. It was insulting, and it made prosecutors' jobs very easy. On December 12, 2022, SBF was arrested in the Bahamas at the request of U.S. prosecutors, and the indictment was damning. 8 counts including wire fraud, securities fraud, money laundering, and conspiracy. The prosecutors alleged that from the very beginning, from FTX's founding, SBF had intended to use customer deposits for his own purposes, that the fraud wasn't an accident or a mistake made during crisis, but was built into the business model from day one. And they had receipts, they had Signal chats where SBF and his executives discussed moving customer funds. They had testimony from Alameda employees who were told to use FTX customer deposits for trading. They had Caroline Ellison's private journal where she wrote about the stress of lying to customers and investors. It was all there, documented, undeniable. SBF was extradited to the United States, released on a $250 million bail secured by his parents' house, and required to stay at his parents' home in Stanford, California. And then he did something that absolutely baffled his lawyers. He kept talking, he kept giving interviews, he kept posting on Twitter trying to shape the narrative, trying to convince the world that he was innocent. And every time he talked, he gave prosecutors more evidence. He contradicted his own statements, he admitted to things that his lawyers must have been screaming at him not to admit to, and prosecutors used all of it against him at trial. The trial strategy from SBF's team was predictable. They argued that he was a naive founder who got in over his head, that he had made business mistakes but hadn't committed crimes, that he had relied on lawyers and advisors who failed him, and that the collapse of FTX was due to a bank run and market conditions, not fraud. But this strategy had a fatal flaw. They had to put SBF on the stand to tell this story, and SBF was a terrible witness. The trial started in October 2023 and the prosecution's case was devastating. They called Caroline Ellison, who had pleaded guilty and was cooperating with prosecutors, and she testified for 3 days about everything. How SBF had directed her to use FTX customer funds for Alameda's trading, how they had lied to investors and lenders about Alameda's financial condition, how SBF had known exactly what was happening and had been the decision-maker on all major issues, how he had told her to lie about the relationship between the two companies. She brought receipts, she brought Signal chats, she brought her journal where she had written about feeling overwhelmed by the fraud she was participating in. And crucially, she explained that this wasn't a crisis response, that they had been using customer funds since 2019, from the very beginning of FTX. The prosecution also called Gary Wang, who had been FTX's chief technology officer and had also pleaded guilty, and he testified about the special privileges that had been coded into the FTX system specifically for Alameda, the backdoor that allowed Alameda to have a negative balance to borrow unlimited amounts, to avoid the liquidation mechanisms that applied to other customers, and he testified that SBF had specifically requested these features, had reviewed the code, had known exactly what they would allow Alameda to do. Then SBF took the stand and it was a disaster. He claimed he couldn't remember basic facts, he gave contradictory answers, he tried to blame everyone else while simultaneously claiming he had been in charge of everything important. He insisted he had made mistakes but hadn't committed crimes, but he couldn't explain the difference. He couldn't explain how you accidentally steal $8 billion. He couldn't explain why he had lied to investors and customers if everything was innocent mistakes. And most damning, he kept getting caught in lies. The prosecutors would show him a Signal chat or an email where he had said something completely different from what he was testifying, and he would claim he didn't remember or that they were taking it out of context. But there were hundreds of these receipts, a paper trail of fraud stretching back years, and after 3 days of testimony, even SBF's own lawyers looked defeated. They knew it was over. The jury deliberated for less than 5 hours before returning guilty verdicts on all 7 counts, and when sentencing came in March 2024, Judge Lewis Kaplan was brutal in his assessment. He said SBF had lied during his testimony, had shown no remorse, had obstructed justice, and had committed one of the largest financial frauds in American history. The government had asked for 40 to 50 years. The defense asked for 5 to 6 years. Claiming SBF was already suffering, and that customers would eventually be repaid through the bankruptcy process, Judge Kaplan sentenced him to 25 years in federal prison, making him effectively 55 years old when he would be eligible for release. And in his statement, the judge specifically noted that SBF had testified falsely, had shown no real remorse, and posed a risk of committing future crimes if given the opportunity. This wasn't justice system being harsh on a young founder who made mistakes. This was a judge who had heard all the evidence and concluded that SBF was a calculating fraudster who had stolen billions and lied about it repeatedly. But here's what makes the FTX story even more disturbing. The institutional failure. How did Sequoia Capital, one of the most prestigious venture capital firms in the world, invest in FTX without discovering that customer funds were being misused? How did BlackRock, with all its resources and expertise, miss this? How did the Ontario Teachers' Pension Plan, which has a fiduciary duty to Canadian teachers, fail to do adequate due diligence? And the answer is uncomfortable: they didn't want to find problems. FTX was growing incredibly fast, crypto was hot, they had FOMO, they saw their competitors investing and didn't want to miss out, and SBF was incredibly good at telling them what they wanted to hear. He spoke their language. He had the right credentials, he said he wanted regulation and oversight, he seemed like the safe bet in a risky industry. And so they invested hundreds of millions of dollars without properly examining the business, without insisting on audited financial statements, without demanding to understand the relationship between FTX and Alameda. The regulatory failure is equally disturbing. The SEC, the CFTC, the Justice Department, they all knew about FTX. SBF had testified before Congress. He had met with regulators, he was actively lobbying for cryptocurrency regulation, and nobody thought to examine his companies closely until after they had collapsed. And when you look at the fraud, it wasn't sophisticated, it wasn't some brilliant scheme that could fool forensic accountants, it was basic theft. Moving customer money to a related entity and spending it, any competent audit would have discovered it immediately. But nobody did an audit, nobody asked the hard questions because SBF had successfully positioned himself as one of the good guys, as someone who welcomed scrutiny and oversight, and that reputation insulated him from actual scrutiny until it was too late. The FTX collapse also revealed the fundamental problem with the effective altruism movement, or at least how some people practice it. SBF had claimed he was only getting rich so he could give the money away, that he didn't care about wealth for its own sake, that he was going to donate billions to the most effective charities and causes, and many people in the effective altruism community defended him even after the fraud became obvious. They argued that his intentions were good even if his methods were wrong, that he had really believed he was doing the right thing by taking risks with customer money because he would eventually make it back and donate the profits. This is moral reasoning that would make a mafia boss blush. You can't steal billions of dollars and claim it's okay because you were planning to donate some of the profits to charity. That's not effective altruism, that's just theft with better marketing. But somehow SBF had convinced himself and many of his followers that the rules didn't apply to him because his goals were noble. Caroline Ellison was sentenced to 2 years in prison despite her cooperation. The judge acknowledged that she had been instrumental in helping prosecutors, but that she had also participated in a massive fraud that hurt many people, and her sentencing hearing was emotional. She apologized to victims, cried, expressed genuine remorse in a way that SBF never had, and while 2 years is light compared to SBF's 25, it's still prison. It will still destroy her career and follow her forever, and in many ways she's a tragic figure, brilliant, talented, who got involved with the wrong person and made terrible decisions that ruined her life. Gary Wang received no prison time, just probation, because his cooperation had been so extensive, and because the judge believed he had been less culpable than Ellison or SBF. But his life is also effectively over in terms of his career. Nobody will trust him again, and he'll spend the rest of his life known as the CTO who helped steal $8 billion. The FTX bankruptcy is still ongoing, but there's a twist that makes this story even stranger. Because cryptocurrency prices have gone up significantly since FTX's collapse, the assets that FTX holds, the cryptocurrencies that were valued at low prices during the bankruptcy filing, are now worth much more. And this means that the bankruptcy estate might actually have enough money to repay customers in full or close to it, and SBF's lawyers tried to use this at sentencing, arguing that there were no real victims because everyone would be repaid. But Judge Kaplan rejected this argument, pointing out that customers had lost access to their money for years, had missed out on the incredible crypto bull run of 2023 and 2024, had suffered real harm regardless of whether they eventually got their nominal dollar value back, and more fundamentally, the fact that you might eventually repay stolen money because of market movements doesn't make the theft okay. If I steal your car and then the used car market crashes and I can buy a similar car cheaply to give back to you, I still stole your car. The broader impact of FTX's collapse on the cryptocurrency industry cannot be overstated. It was the final straw in a year of disasters that included Terra Luna, Celsius, Voyager, Three Arrows Capital, and BlockFi. Billions of dollars in customer funds lost across multiple platforms, and it destroyed what little trust remained between crypto companies and mainstream institutions. Why would a pension fund or university endowment invest in cryptocurrency when the industry's most trusted company turned out to be a fraud? Why would regulators approve cryptocurrency ETFs or other mainstream products when they can't trust that the companies have basic financial controls? FTX's collapse set the cryptocurrency industry back years in terms of institutional adoption and regulatory progress. And the irony is that SBF had positioned himself as the person who would bring crypto into the mainstream, who would work with regulators to make the industry safe and trustworthy, and instead he became the perfect example of everything that's wrong with cryptocurrency: the lack of oversight, the fraud, the theft, the broken promises. Today, Sam Bankman-Fried is in federal prison, likely for the next 2 decades. His parents lost their house to the bail bond. His reputation is destroyed forever. He will be remembered not as a brilliant founder or effective altruist, but as one of the great fraudsters in financial history, up there with Bernie Madoff and Alan Stanford. And the question that haunts this story is, what was he thinking? Did he really believe he would get away with it? Did he think that as long as cryptocurrency prices kept going up, he could eventually make everyone whole and nobody would notice he had been using their money? Did he convince himself that the rules didn't apply to him because he was special? Because he was smarter than everyone else, because his goals were noble, or was it simpler than that? Was it just greed and ego, the same things that drive every financial fraud? The answer probably involves all of these things. SBF was brilliant but arrogant. He was convinced of his own righteousness. He surrounded himself with people who worshipped him and never challenged his decisions. He operated in an industry with minimal oversight where moving billions of dollars required no adult supervision. And he had convinced himself that taking enormous risks with other people's money was justified because he would use the profits for good. This is the dangerous combination that creates fraud. Intelligence without wisdom, confidence without humility, ambition without ethics, and a belief that you're special enough that the normal rules don't apply. And the tragedy is that this pattern repeats constantly throughout history. From Enron to the Ranos to FTX, we keep falling for the same story: the brilliant founder with a revolutionary idea, the rapid growth that seems too good to be true, the dismissal of critics as backwards or jealous, the eventual revelation that it was all built on lies. The lessons from FTX are clear even if they're hard to accept. First, if returns seem too good to be true, they probably are. There is no magic in finance, no way to generate outsized returns without taking outsized risks, and anyone promising otherwise is either deluded or lying. Second, trust requires verification. It's not enough that someone seems trustworthy or says the right things about regulation and consumer protection. You need actual audits, actual oversight, actual transparency. SBF fooled everyone because we took him at his word instead of demanding proof. Third, concentration of power is dangerous. FTX had no board of directors, no independent oversight. SBF controlled everything and surrounded himself with loyalists who lived in his house and dated each other. This is not how you run a business that handles billions of other people's money. Fourth, regulatory arbitrage has costs. FTX was based in the Bahamas specifically to avoid US regulation, and that lack of oversight enabled the fraud. If FTX had been a US-regulated entity with proper audits and controls, this couldn't have happened on the same scale. But the most important lesson is about human nature. We want to believe in heroes. We want to believe that some people are smarter and better than the rest of us, that they've figured out something we're missing, and this desire makes us vulnerable to fraudsters who are willing to tell us what we want to hear. SBF wasn't a criminal mastermind. He was a math nerd who discovered that if you're smart and articulate and say the right things, people will give you billions of dollars and won't ask too many questions. He exploited our desire to believe in genius, our FOMO about missing the next big thing, and our tendency to trust people who share our values and speak our language. And in the end, this very human vulnerability cost customers $8 billion, destroyed companies, ruined lives, and set an entire industry back years. The next time you hear about a company that's growing impossibly fast with minimal oversight, the next time someone tells you the old rules don't apply because this time is different, remember Sam Bankman-Fried, remember FTX, remember that $32 billion can disappear in 5 days when the foundation is built on fraud. Remember that brilliant people can commit terrible crimes when they convince themselves the rules don't apply. And remember that in finance, as in physics, you cannot create something from nothing. Every dollar of return comes from somewhere, and if you can't clearly explain where it's coming from, you should assume it's coming from you. The story of FTX is not just about cryptocurrency. It's not just about one fraud or one fraudster. It's about human nature, about greed and hubris and the eternal belief that we're special, that we've figured out something everyone else missed, that this time really is different. It's a story as old as the Dutch tulip mania, as old as the South Sea bubble, as old as every financial fraud and collapse in human history. And it will keep repeating with different characters and different technologies until we learn the fundamental lesson that there are no shortcuts, no cheat codes, no ways to bend the rules of economics and mathematics, no matter how smart you are or how noble you claim your intentions to be. Sam Bankman-Fried learned this lesson the hard way, sitting in a federal prison with 2 decades left on his sentence. His net worth obliterated from $26 billion to zero, his reputation destroyed forever, his parents financially ruined, and his legacy reduced to being mentioned in the same breath as Bernie Madoff and Charles Ponzi. But the real question is, have we learned it? Will we recognize the next SBF when he or she appears with their new revolutionary idea and their impressive credentials and their promises that sound too good to be true? Or will we make the same mistakes again, believing that somehow this time it really is different, that this founder really has figured out something that thousands of years of financial history say is impossible? The answer to that question will determine whether FTX becomes a cautionary tale that prevents future frauds, or just another chapter in the endless cycle of human greed, delusion, and the belief that the rules don't apply to us. And based on history, based on human nature, based on the fact that we keep falling for the same schemes generation after generation, the smart money says we'll do it again. We'll find a new SBF to believe in, a new FTX to trust with our money, And we'll learn the same painful lesson all over again, that in the end there really are no shortcuts, there really is no magic, and the rules of mathematics and economics apply to everyone, even MIT graduates in cargo shorts who claim they're only getting rich so they can give it all away and save the world. The FTX collapse destroyed $32 billion in value, ruined countless lives, set an entire industry back years, and sent one of the brightest young minds of his generation to federal prison for a quarter century. And the most tragic part, it was all so unnecessary, so preventable, so obviously doomed from the start if anyone had bothered to look closely enough. But nobody did, because we wanted to believe, because the alternative was admitting that getting rich requires patience and discipline and luck, not genius and disruption and revolutionary new technologies. So remember FTX, remember Sam Bankman-Fried, and the next time someone promises you returns that seem too good to be true, believe your instincts, because they probably are. In finance, as in life, if something seems like magic, it's probably just a trick, and the only question is how long it takes before everyone sees through the illusion and the whole thing comes crashing down. For FTX, it took 5 days. For your next investment, the clock is already ticking.